You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by Purepoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's May 26, 2026, and this week on Uranium Spotlight, Niger cuts another Western supplier out of its uranium sector. A massive U.S. utility merger raises fresh fuel supply questions. India looks to recover uranium from copper tailings, and premium American uranium ramps up major drilling and development programs in Wyoming and New Mexico. The uranium spot price closed last week at $84.35 a pound U3O8, down from $85.10 at the start of the week. Market activity was relatively subdued, but the broader pricing picture remains significant as the uranium market continues to tighten beneath the surface. Spot prices drifted lower through May, with delivery pricing at Cameco and Orano slipping to roughly $83 a pound, while Coverdine delivery remained slightly higher at $84. The much bigger story, however, was in the long-term market. May's long-term uranium price jumped sharply to $93 a pound, up $3 in a single month. That is one of the largest monthly increases we've seen in quite some time and continues to reinforce the growing disconnect between near-term spot fluctuation and the much more strategically important long-term contracting market. Forward pricing also remained firm, with the 3-year forward price sitting at $100 and the 5-year forward price at $107, suggesting utilities and fuel buyers continue to anticipate materially tighter supply conditions ahead. The long-term market tends to move more slowly than spot, but when it begins accelerating, it often signals the utilities are becoming increasingly concerned about future availability rather than simply chasing short-term inventory opportunities. We'll provide a more fulsome analysis on the move next week when the broader monthly contracting data becomes available. For investors, the key takeaway is that while spot prices may continue to fluctuate week to week, the long-term market is quietly sending a much stronger signal about future uranium scarcity and utility urgency. The Republic of Niger has revoked any rights that French state-owned company Orano had at the Arlit deposit in northern Niger. This comes after months and years of continuous removal of rights over various mining arrangements for Orano and a limited number of other Western companies. The actions taken against Orano by the military government that seized power in a coup in 2023 included but were not limited to the prevention of uranium exports leaving the country due to new security measures, the seizure of mines in Somer and Imoran, and attempts involving the transport of uranium assets after those seizures. There was also a terrorist attack in Niamey Airport involving uranium reportedly destined for Russia, and later negotiations with Niger agreed to return uranium equivalent to Orano's share in the mine. The latest revocation at Arlit now effectively locks Orano out of future uranium development in the region. More importantly, it potentially opens the door for Niger to transfer strategic uranium assets towards countries more aligned with the current government, including Russia, China, or Turkey. Niger stated that the revocation was tied to unpaid fees and royalties connected to mining activities around the concession parameter. The bigger issue, however, is geopolitical. Niger has increasingly moved towards the Russian-backed alliance of Sahel states, while at the same time Chinese and Russian influence across African uranium districts continues expanding. Namibia has already seen increasing ownership by Eastern-aligned companies, while countries like Zambia and Botswana remain among the few large African uranium jurisdictions still substantially controlled by Western interests. That raises a broader strategic question. Where will Western utilities secure future uranium supply? Australia holds the world's largest uranium reserves, but still faces various legal and permitting constraints across several states. Canada, meanwhile, remains one of the most mining-friendly jurisdictions globally and hosts the world's highest-grade uranium deposits, though even Canada has recently faced operational disruptions from flooding and wildfires in Saskatchewan's Athabasca Basin. For investors, this matters because uranium is increasingly becoming a strategic geopolitical resource rather than simply a commodity. As Western access to global supply narrows, high-quality projects in stable jurisdictions such as Canada, the United States, and Australia become materially more valuable. Two giants of the nuclear energy industry, NextEra and Dominion Energy, moved towards a merger last week that would create the world's largest electric utility by market capitalization and one of the largest electric infrastructure companies globally. Together, the combined company would control 15 nuclear reactors across 8 power stations throughout the southern United States, including facilities in Florida, South Carolina, North Carolina, and Virginia. NextEra currently services approximately 12 million customers in Florida, while Dominion Energy serves another 3.6 million customers across the broader southeastern region. The scale of the merger matters because larger utilities generally have a much stronger ability to finance reactor extensions, uprates, and potentially new nuclear construction. In an environment where the United States is increasingly focused on expanding nuclear generation to support grid reliability and data center growth, this creates another major institutional player capable of pursuing large-scale nuclear investments. But the merger also highlights a growing problem that the uranium market keeps circling back to. Where will the fuel come from? The United States currently produces only a fraction of the uranium it consumes and remains heavily dependent on imports. While domestic uranium production has begun recovering modestly, it remains nowhere near sufficient to support a major expansion of the reactor fleet. That means future demand growth likely pushes the U.S. further towards allied uranium suppliers such as Canada and Australia. At the same time, Australia still faces regulatory and political hurdles to significantly expanding production, while new uranium mines globally continue facing long permitting timelines, capital intensity, and growing geopolitical complexity. The reality is that new reactors, whether conventional large-scale plants or emerging SMR fleets, cannot materialize at scale without corresponding growth in uranium mining and fuel cycle infrastructure. Governments may increasingly need to provide regulatory support, financial backing, and strategic initiatives to ensure enough uranium supply is developed in time. For investors, this matters because the uranium market is continuing to build future reactor demand assumptions faster than new uranium supply is realistically being developed. Every major nuclear expansion story ultimately circles back to the same issue: securing reliable long-term fuel supply. Uranium Corporation of India Limited announced new plans last week to extract uranium from copper tailings at Hindustan's copper mine. The move highlights just how aggressively India is attempting to secure future uranium supply as it expands its nuclear ambitions. India's relatively limited domestic uranium resources compared to the scale of its reactor plans. Like the United States, it already operates a meaningful nuclear fleet while simultaneously planning major future reactor construction. That combination has created increasing urgency around long-term uranium security. The new agreement between the two state-owned companies appears aimed at recovering whatever uranium can economically be extracted from existing mining waste streams. The fact that uranium recovery from copper tailings is now being actively pursued illustrates how tight the broader uranium market has become and how valuable even marginal domestic sources are increasingly viewed. India currently has 8 reactors under construction and another 10 in various stages of planning. More importantly, the country has publicly stated a goal of reaching 100 gigawatts of nuclear capacity by 2047, roughly equivalent to around 100 large-scale AP1000 style reactors. That would represent an enormous expansion from India's current nuclear fleet. The challenge, however, is obvious. Recovering uranium from copper tailings is unlikely to provide anywhere near the amount of material required to support an aggressive nuclear build-out. Even the announcement itself did not specify how much uranium might ultimately be recoverable from the project. India therefore joins a growing list of countries now competing for limited future uranium supply at the exact same time new reactor demand continues accelerating globally. For investors, this matters because it demonstrates that uranium demand growth is no longer limited to Western utilities alone. Countries with limited domestic resources are increasingly scrambling to secure supply from every possible source, reinforcing the growing structural tightness developing across the global uranium market. Premier American Uranium moved aggressively on 2 fronts last week, launching a major new drilling campaign at its Casey ISR project in Wyoming, while simultaneously advancing metallurgical optimization work at its Cebulata project in New Mexico. At Casey, the company commenced a massive 100,000-foot drilling program focused on expanding known uranium mineralization and further defining roll front targets across Wyoming's Powder River Basin. The work includes roughly 33,000 feet of step-out drilling at the Outpost target, another 51,000 feet at Rustler, and additional drilling near historical coal bed methane wells where newly interpreted uranium trends are being evaluated. Premier also expanded its land position to nearly 30,000 acres while completing detailed survey work designed to support future mineral resource estimation. The company noted that Casey now represents one of the largest grassroots ISR exploration projects in the United States, with more than 400,000 feet of drilling completed since 2023. At the same time, Premier began drilling at its Cebolata project in New Mexico as part of a major metallurgical testing program aimed at improving uranium recoveries and strengthening project economics. The program includes up to 16 PQ core holes feeding a 42-week laboratory campaign focused on optimizing heap leach recovery assumptions used in the project's 2025 PEA. The economics are meaningful. The company stated that increasing metallurgical recovery from 80% to 90% could potentially increase the tax net present value by roughly 90%, from approximately $84 million US to $159 million US. At $125 US per pound uranium, the after-tax net present value increases to more than $325 million US, according to the study. For investors, the key takeaway is this. Premier American Uranium is attempting to build exposure across both near-term development and large-scale U.S. exploration growth. In a market increasingly focused on domestic uranium supply security, projects capable of supporting future ISR production or scalable U.S. development pipelines may continue attracting growing strategic attention.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by Purepoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.